Delighted to be joined by my panel today, and I'll have them introduce themselves. Tushar.
Yeah, hi all. My name is Tushar Sial. I'm the SEO for Schonfeld Strategic Advisors, which is a multi-strat hedge fund. We've been in the DIFC for 2 years.
I'm Ryan Taylor. I'm a Senior Managing Director for Brevan Howard. I'm the Group Head of Compliance for Brevan Howard as a whole. I'm the CAIA for our digital crypto business, and I set up our office in the ADGM 18 months or so ago.
I'm Brandon Robinson. I'm Deputy Head of Private Markets at JPMorgan Asset Management. Our platforms call it 220 billion or so of total assets under management. Our hedge fund business is about 25 billion. And I'm responsible for client engagement as well as effectively the COO of our platform. Happy to be here.
Hi, I'm Jonathan Beardall, Head of Wealth and Asset Management at the DIFC Authority, responsible for the business development of all the wealth and asset management space with a big focus on hedge funds, and joined here today with lots of our clients.
So Jonathan, let's start with you then. When I was here 12 months ago, there was a great buzz about the region, in particular about hedge funds that were expressing an interest in coming to the UAE. Perhaps you can update us on what's happening here in Dubai.
Sure. The growth has been unprecedented. We thought the growth was good last year. It's been just as good again. We've got 65 pure play hedge funds in the center as things stand today, 48 of which are $1 billion plus, and that's in constant growth. We'll be crossing the 70 mark in the next sort of 4 or 5 weeks, and certainly well on track by mid next year to be over 100. And that's part of the story. We've grown to over 420 asset management firms within the center as well. And it's not just been the story of getting the firms in, it's been about deepening the core of those relationships. And I think we announced on Bloomberg a few weeks ago that we now have over 1,000 hedge fund employees within the DIFC. And again, that's constantly growing.
Thank you, Jonathan. Ryan, he talked about the number of funds that are in the DIFC here in Dubai, and it's fair to say a large percentage of that are macro managers and multi-manager platforms, Tushar. But why the continued interest in the region amongst macro managers?
To me or him?
To both of you, please.
You can go first. Go on.
Yeah, sure. Well, I mean, look, I think we go back, hedge funds, you had people coming out of large asset managers from banks, who were setting up their own sort of single strategy funds. But what became apparent was in a stress market situation, you have those single strategy funds having their own set of challenges and struggles, which again, and this is my personal view, I think, that's why kind of diversification comes into play. And that's where multi-strat comes into play, where in the same fund, you could have, a macro manager, a portfolio manager who's navigating policy shifts globally. You could have a long-short portfolio manager who's looking at volatility in the stock market. Quant systematics, I would say, who's looking statistically like where the anomalies exist, or just arbitrage opportunities for some of the Delta 1 strategies, for example. If as an investor I want to recreate all of that, I think there's a huge amount of resource constraint, or maybe huge cost if I'm trying to go for a fund of hedge fund strategy. So I think that's kind of multi-strat, combining all of those strategies under one umbrella. So I think that diversification is what has driven, given how much stress that we've seen in the market in the last few years. That's one thing I would say. And then other than that, I think it's easily scalable. So because you have a diversification of strategies, big allocators, for example, there's never a question around, can I actually deploy that capital? There is deployment possible. I would say flexibility as well. Because you have so many strategies, it's not like you have to sit on cash if the market is not favorable to you. You just take out money from one manager, give it to another manager within the same umbrella. So I think that flexibility exists. And I guess we can. One of the things that we believe again as a firm is retaining top talent as well as multi-strat, because single hedge fund, single portfolio managers trying to run the entity, trying to raise capital. Whereas when they come into a port shop like ours, for example, they can, probably I would say focus on risk taking and leave the managing of the entity and capital raising on us. So I'll stop there, but I think a lot of the factors make it a good proposition.
That's great, Tushar. Thank you. Ryan, do you want to add to that?
Well,
Has he covered everything?
I've not got much more to say in relation to multi-strats because it's been very well covered. At Brevan, we have a multi-strat fund, large fund. We have a macro fund. We have a number of different funds, all of which are represented in the ADG, and we have over 100 people here. So break down the questions, two pieces. One, why the UAE, and then two, really, why the strategies. Multi-strat's been covered. You can scale it. There's lots of capacity. Macro, well, if anybody's been here all day, they would have heard about geopolitics numerous times. And I think the only person who's positive about the future direction of geopolitics is Boris Johnson, because he's kind of happy about everything, and fair play to him. Everybody else kind of thinks that there's going to be a lot of uncertainty, a lot of volatility in the market. If you look at macro hedge funds, they do well during volatile and uncertain times. You look back at 2020 with COVID, you look back at 2022 with the surge of inflation. Central banks get involved. When central banks get involved, you tend to have opportunities in relation to macro. We're going to definitely be moving into a heightened period of volatility and uncertainty on an ongoing basis. It makes macro attractive. In addition to that, actually, what we're seeing is a huge divergence in economic conditions in different countries. So the US has a strong economy and inflation is dropping. The EU has a weak economy and inflation is dropping. Japan has a relatively strong economy and inflation is increasing. China has a weak economy and they're introducing a whole host of stimulus. There's a UK I'm not going to go into because it just makes me a bit sad as to where the UK is, particularly given the forthcoming budget, but that's a different matter. We're almost at an unprecedented, in certainly recent memory time, of divergent economies, divergent interest rates, divergent inflation, divergent growth, and that just creates a huge opportunity in FX and in interest rate trading, risky asset trading as well. All of that plays into the macro investment thesis, and so that's why I think we're seeing a lot of that. So that's macro. Why the UAE? Time zone. You can trade Asia. From here, you can trade Europe, you can trade the States, and if you're doing macro, it's a global play, so you need to be able to cover all of those markets. So time zone's hugely important. The regulators, both in Dubai and indeed in Abu Dhabi, are phenomenal. They're hard regulators, but they want the industry to thrive. And so they write sensible regulations, and they're also prepared to talk to the industry in order to evolve those regulations where it's important for the industry as a whole. And you see that in relation to additional new asset classes as well, such as digital assets, crypto. As I say, I'm the CEO of our digital business as well. We run about 2 billion of our 35 billion assets under management are in crypto. And we do a significant proportion of that in the UAE and in the ADGM, because it's an asset class which is part of the future, and it's an asset class which is welcomed by the regulator, and they're seeking to write rules, which is unusual in a number of jurisdictions, rules actually about crypto, and specifically for crypto, and in doing that in order to further the market. So there's a real vision here. So you have the time zone, you have visionary regulators, you have zero tax, and moved out from the UK about 18 months ago. I'm still really happy about zero tax. I think I probably always will be. Certainly following the forthcoming budget at the end of the month in the UK. So you have all of those drivers, and as Nick said as well, you have stability. Nick, Andy, your earlier session, if you didn't see it, you have stability. And you have a real thriving ecosystem where everybody wants to get something done. You bring all of that together, and so for us, it's a phenomenal place to do our business because it's a phenomenal environment, geographically, time zone, but also the macro economic strategies which we trade. You're seeing a microcosm of it here. We understand macro. Why would we not be in one of the fastest growing jurisdictions and environments in the world? It would be stupid. So we like to think we're not stupid, which is why we have a large presence here as well. We have about 100 people here now, so about a tenth of our workforce, and we manage about 10 billion of our 35 billion from here. So it's been a phenomenal success story for us. I probably answered about 5 questions there.
No, yeah, indeed, yeah. Well, we might have time to take some of them apart. But Brandon, how would you, bringing you into the conversation, how would you characterize the interest then when you think about hedge funds globally coming here, outside of UK, which Ryan has alluded to, elsewhere in the world? What are you seeing?
So what are we seeing? I mean, look, let's maybe take a step back and kind of talk about the hedge fund industry in general. I mean, we're at a peak, if you will, in assets under management globally, over 4 trillion at this point. There's a lot of capital being put to work globally in the hedge fund space, and whether it is in macro, relative value, quant, et cetera, et cetera. And that's happening over a same period when you actually are seeing fewer managers actually managing in this space. We're launching larger funds at this point, so there's a bit of a consolidation happening. But what we're also seeing is new opportunities, such as those that are happening here in the UAE, whether it's related to the equity market or other opportunities, and we're really all excited about that. I mean, we ourselves are talking to a number of GPs here. You know, the way we manage our platforms, we tend to invest in other hedge fund managers and put together customized solutions for clients. And so we're constantly looking for interesting opportunities. And you all may have heard from Bob Michael, who's our head of fixed income at JPMorgan. He oftentimes will say bonds are back, or at least he did a year and a half ago. And that trade is sort of running its course a little bit. But volatility came back with those bonds, right? And the equity vol has been relatively stable, but it's to some degree back. And that has actually created an opportunity for hedge funds, if you will, to be back. And the alpha in the hedge fund space to be back. And we're all pretty excited about that. We're seeing on our own platform, my colleagues here are definitely seeing that. And it's a great time to be investing. And, you know, here in particular in the Middle East or in the UAE, you know, as the infrastructure continues to have significant investment being made in it. The regulatory environment is extremely favorable. You know, the conditions are extremely favorable to generate alpha over cash, which is typically how we manage our hedge fund platform. We're all excited, actually, to be here and to be growing here in the region. And clients outside of the region are looking to invest with us and with my partners here as well to be able to take advantage of these emerging trends.
Right, thank you, Brandon. Tushar, we talked about it a little bit, but there is a continued interest, euphoria nearly, about the multi-manager model. And why do you think that is? And my second question is, to what extent is the multi-manager model able to adapt to the changing conditions that the panel has mentioned?
Right. I mean, well, I think, you know, one thing I would say, when we think about multi-strat, we are thinking of the kind of investors who are looking for a stable stream of return, risk-adjusted returns, and they don't, which is, I would say, uncorrelated to traditional assets. So I think that's kind of, and then which is again where the risk management comes into play. That, you know, you have this, you know, multi-strat. The risk manager, one of the most important jobs is to ensure that, you know, the sensitivities regarding equities, do they exist in the portfolio? How do we reduce that if that does? Is there sensitivity on rates, for example? So on and so forth. So I would say risk management, again, you know, that's the biggest, or that's the most important piece when we think about, you know, sort of multi-strat hedge funds. Again, you know, risk management could be various levels. It could be portfolio level from a, you know, I talked about correlation or leverage, for example, or it even could be, you know, at the manager level, where I would say it's less about policing. It's more about how can we actually help the portfolio manager achieve enhanced returns. So whether it's their drawdown targets, whether it's their, you know, stop loss limits or their, you know, wall targets, etc., concentration limits, liquidity, all of that, I think when it all comes together is what actually makes you uncorrelated to traditional assets and gives you that stream of returns. Which is why I think, you know, to your point, then that makes it adaptable as well. Because it's no longer me as a long short, again, I'm just for the sake of discussion, as a long short equity manager, there's a stock market stress, what do? I sit on cash, I dilute my returns. But as a multi-strat, I might actually pull some capital out and put it into credit or something else, for example, or macro. And that's how you kind of, you know, still provide the investor a correlated return, uncorrelated returns to the market.
And Brandon, in terms of the allocator perspective, and what are you seeing in terms of interest into these platforms?
I mean, at the end of the day, we are seeing significant allocations coming into the multi-strat space for many of the benefits that were just mentioned. I mean, it's a huge diversifier in a portfolio. I mean, when you think about what clients are investing in, you know, you have your traditional 60-40, and then you're starting to allocate into, call it up to 10% into alternatives in general, including hedge funds. And what is it meant to do in the portfolio? It's meant to be uncorrelated return stream. It can provide some income, it can provide some alpha, and overall just be a diversifier. And the way that we feel about multi-strat is that that's one of the best ways in order to do that within the hedge fund space. And it's growing. And I talked about how we're seeing fewer managers launching.
Mm-hmm.
That consolidation is actually providing even more of a catalyst to be investing in those multi-strat firms that are there today as they grow. I mean, there's a bit of a talent battle, if you will, going on between the different managers.
War of talent.
War on
I'd
talent.
avoid the word
more of a
war. There's
battle.
so much war going on. Yes, but what we're seeing is as a result of that, it is extremely important to be good at picking which managers you use, and then those managers need to be good at picking the managers that they are using across the multiple strategies. And if you can get that right, you know, you can really provide a lot of benefit to your clients. I mean, I talked about how you know, hedge funds are back, if you will. Over the last, call it 25 years, we've seen roughly three different sort of cycles, if you will, in this space. So 2000 to 2010, you know, hedge funds were generally producing, on the whole, 7% alpha over cash. You know, and even if you stripped out 2000, which was like a kind of a crazy year in returns, you're still pretty close to that 7. And then we went through 10 years of kind of boring returns. Sorry.
Boring's good, though.
Yeah, it can be.
No,
Well, in the beta market that we were in, you know, we did see some clients allocating away. But now what we're seeing again from 2020 to today is that 7% plus alpha again, right? And that's actually coming as a result of the conditions that we've talked about. And if you can do that in a diversified way, which multi-strat managers help us with, it is an extreme catalyst for growing allocations into private wealth portfolios in particular.
And also, these platforms are moving into the private market space as well, right, Brandon?
That's right.
Talk a little bit to that.
Yeah, I mean, look, what we're seeing, particularly in the private markets, is private credit. Right, so private credit is a growing allocation within the sort of the hedge fund arena, whether it's in structured credit, whether it is in distressed, and it's putting together portfolios that can actually take advantage of these dynamics. So direct lending obviously exploded over the last 10 to 15 years as a huge you know, catalyst of capital coming into a number of companies. And there's a trade to be made there, even in relative value, as we look at sort of emerging trends as that market matures. There will be opportunities for secondaries and relative value trades in that space. And we're talking about illiquid loans here, but at the end of the day, what we're also excited about is that there's going to be opportunity there, as I mentioned, distressed, secondaries, and then also if you look at the industry landscape underneath that, which private markets sectors are important. So not just how capital is coming in, but what is it investing in? Biotech. We're seeing a significant amount of allocation into the biotech space, into the private market space of biotech, because valuations are attractive, because of obviously, you know, and you can't have a meeting without talking about GLP-1, you know, because of the drugs that are coming out in the anti-obesity space. There is a trade to be made there, and in the hedge fund sector, we're able to take advantage of those depending on access to GPs that are looking to invest in that space.
And Jonathan, it's fair to say people on the stage here with me are from that first tier of asset managers. But I know that you've been working extremely hard with the regulators here to try to accommodate the next layer down of the industry. What can you talk to the audience today about? You've got some developments that have and some news around that?
Sure. I mean, look, just think what hedge funds represent for a financial center. It's a certain evolution, you know, and we've got to that stage where the large multi-strats came. We've all heard a lot about that, but it's linear. So from that point, you're then looking at the spin-outs and you're looking at those smaller firms setting up. And, it makes a lot of sense to set up in a financial center if you've got 30 billion, 20 billion, 100 billion AUM, and the barriers to entry around cost are not too restrictive. And those who want to spin out, if they've been seeded by the parent company, that's absolutely fine. It makes sense. But for those who are starting out and trying to accommodate more funds within the DIFC, for example, we have our fund platforms. Our regulatory hosting platform, Capricorn, was authorized just a matter of weeks ago now to really allow smaller managers to come underneath that umbrella. It's been a lot of work with the DFSA, and I think the regulatory framework, and it'll be on kind of, the full regulatory framework in the whole UAE, FSRA, DIFC, and with the DFSA, is incredibly open for dialogue, and it's something that people are just not quite used to in other parts of the world, and it works. Private credit, you mentioned earlier, in the interest of assisting those firms setting up, we have a firm who wanted to come and move their HQ from Hong Kong to the DIFC, but they couldn't because our private credit regulations weren't great. So guess what? Bring in the lawyers, get the regulator around the table, change the private credit regulations as long as we find precedent and it sits within our risk appetite. It's a great example of the evolution, and what that does is it allows us to cast the net wider. And we've, again, working with our regulator.
Thank you.
We've removed the requirement, for example, for closed office space for managers as well, for within the DIFC. So that it means that people can come in on a smaller start point. If they don't want to use a hosting platform, that's okay. But maybe they just want a small footprint, one manager to come and set up in the center. The CapEx, OpEx commitments, which can be quite off-putting, which I appreciate, are being reduced as much as possible. We have a target, a directive to try change our center into a fund center, and that comes in two parts. One is the concept of the whole center being somewhere that there's more funds domiciled. At the moment, a lot of work needs to be done on the growth of that. We went from 440 billion at the end of 2023 AUM to 720 at the end of H1, so fast approaching $1 trillion, but the number of funds domiciled in DIFC is about 188. So there's a lot of, and we market about 10,500. So there's a big gap there. And now, just final point on that, the fund center, we're building a physical space in the DIFC, just underneath where the gate building is over the road, that will accommodate these smaller funds coming to set up. So it includes co-working spaces, closed offices, shared meeting rooms. It's more of a shared office type arrangement rather than just making people have, their own huge offices. So lots of things have been done, and then it's also introducing as many funds as possible to our private wealth framework, which, there's 800 or 900 family office structures within the DIFC today. So it's trying to do as much as we can. It's incumbent on us to be community builders as much as it is just to try and get firms in. And that means connecting GPs and LPs as well.
Thank you, Jonathan. Just shifting gears back to geopolitics and to macro trends, it's fair to say, Ryan, the fear and the anxiety around higher levels of inflation have gone for now, but it's been replaced maybe by fears of economic recession. So is that yielding any new macro themes that maybe you can elaborate on?
Yeah, it's great. It's not. So it depends on your perspective. But inflation hasn't necessarily gone. It's being tamed at the moment, but there's a whole host of potential situations which could revive it. If the US goes on a spending rip, which it could do, given some of the promises which have been made. China is trying to reflate its economy, largely because their property market is going rapidly downhill. And so they need to reinflate that in order to basically keep their economy chugging along. So yes, there's been some deflationary pressures coming from certain jurisdictions, but there's inflationary pressures coming from others. But the point being is, and the point made earlier on, which is certainly in my living memory, and I'm older than I'd like to be, I can't remember a time when there were so many major divergences in the major economies. And part of this, I guess, is because of the reverse of globalization, etc., and polarizing the world. But the opportunities are immense. The US has a huge amount of wiggle room. It's a reserve currency, it always will be, but this economy is very strong. And it's almost entering into, it gets lost in the rhetoric about, have the Democrats done a good job, are the Republicans going to do a better job? The American economy, and I know it's been mentioned before, is an absolute powerhouse, and it's doing phenomenally well. The European economy isn't. It is a powerhouse, but it's doing really badly. And you've got, even in Europe, you've got divergence between, say, the periphery, where you've got Spain doing well, versus Germany, which is now entering its second year of recession. All of these create frictions in the global macroeconomy, which are tradable. And my own personal view is, if you look at, as I say, Europe, the US, the UK, Japan, China, the emerging markets, there are so many potential trading opportunities coming up. Yes, there's relative value. Yes, there's multi-strat, which will take advantage of this. But the one which, if it gets it right, which will hit the ball out of the park, will be macro.
Brandon, in the few minutes we have left, maybe you could talk a little bit to the benefits of allocating, from a risk-return perspective, dealing with your clients around maybe some of the more niche strategies out there in the hedge fund space.
Yeah, and maybe if I can change the word niche to new opportunity.
New opportunities then, even better.
You talked a little bit about the geopolitical risks, and no one wants to necessarily focus on taking advantage of any kind of a tragedy that's ever happening around the world. But we have to be investing capital at all times. And there are strategies that can be defensive, or they can sort of be tip of the spear in these difficult environments. Climate change is one of the effects of climate change is one of those areas where tragedies can certainly happen. But at the same time, capital is still being put to work, right? And so one of the sort of supply-demand opportunities that we have seen over the last few years has been in the reinsurance space. Right. We're not looking to take advantage of any kind of weather disasters or anything like that. But the gap between the amount of capital that's going into reinsurance and the need for it creates a situation where premiums are still relatively attractive in that space. And on our platform, we've been investing in managers that can produce both defense in this supply-demand regime, but just overall strong returns. I mean, in our own portfolios, we've generated over 25% returns over the last couple of years, and when we look out on the horizon, we don't see those returns, at least with our managers, diminishing in the near term. And so we've just seen this as an emerging or a new opportunity as opposed to niche. Sometimes folks don't necessarily think about reinsurance as being a hedge fund strategy, but it can be, depending on how you invest in it. And the way we've been doing it has actually benefited our clients pretty well.
Okay. Anybody else want to elaborate on any other strategies or
Well, I mean, I would say,
opportunities?
for us, I mean, one is, yes, predicting the return and having a play on that. But I think the also the other side of the equation, which we talked about earlier on the risk management side of things, you want to put more investment into risk analytics and beefing up that function so you can actually simulate exactly what would it look like in a stress market environment or any of these new sort of events, geopolitical events that we are talking about. How would we respond to that, and how soon we can adjust so that we are sticking to our mandate to the clients. So I think that's the way I'm going to look at it.
And I might add as well, leveraging the use of technology, Ryan. Yes. AI, I mean, it's being talked about and be talked about tomorrow, but hedge funds are taking a much greater interest in using AI as well across front right through to the back office.
Yeah, you can't come to a panel or a conference nowadays without talking about AI, obviously. So AI is important, and it's a way of assimilating a lot of information and assessing patterns and creating future projections. My own view is anybody, and this is my view, anybody who relies purely on AI to make their investment decisions for them is stupid. Because it's still a relatively nascent technology. Well, I say relatively nascent, actually. It's been around since the 1950s. It's been developing at quite a slow pace. And now it seems to be on an acceleration. But at the end of the day, it's still relatively new. We would just use it as another data set. We utilize, and hopefully as it gets better, then that will finesse the data going into it and obviously the decisions which come out of it, but then we will have people who will make decisions in relation to it. So as with all investment techniques, you can't rely and solely rely on one thing. You have to look at many different factors. AI is a factor, but most hedge funds have been using similar type strategies for a long time. It's just accelerating now, but at the end of the day, it's the quality of the data going in, the quality of the algo, which is effectively crunching that data, and then the quality of your decision making when the output comes out. So don't rely on it fully, but yeah, absolutely use it as a factor to impact upon your investment decision. You should do.
Last word to you, Brandon.
I would say that we want to continue to look at new opportunities. I talked about reinsurance. Another one that we continue to focus on in the credit space in particular is convertible debt. And that's going to be something that as new as the convertible debt maturity wall, if you will, hits us in a couple of years, it's going to be extremely important to be active in that space. And through multi-strat platforms, through hedge funds broadly speaking, this is an area where you'd be able to access the dynamics of the convertible debt market, which are ever emerging.
Thank you again for taking the time to listen to this panel, and many thanks to my panel.